How millionaires build wealth using life insurance. Now, this is a key part of generational wealth. So I cannot wait to break it down for you. Several things we're going to talk about. How do you leverage the cash value of life insurance? And the second thing I want to talk about, which is just as important, are the benefits of how do you borrow against the policy so you become your own bank. It's called infinite banking. And the last topic I want to talk about is the common mistakes that constantly happen when you're using life insurance to build wealth. Because remember, that's the topic. And there's a lot of insurance out there. I call it death insurance that people have. So one of the things I want to do today is I'm going to bring in one of my experts, my leading expert partner of mine, Jason, who's going to talk about these points. And he is the lead expert on our team to help you when you are ready to say yes and figure it out. So Jason, welcome to our interview today.
Hey, I'm glad to be here. Thanks.
Thank you. So let's talk about this first, section, which is, how do you leverage the cash value of life insurance? It's such a commonly asked question.
Sure. First thing I think people need to understand that the right type of life insurance has a cash value or a cash surrender value, which is like your equity that you have in your house. You buy a house and with each payment, your equity goes up. Same thing happens with regular contributions in your life insurance. Now, you can use that as a way to borrow against it, right? And it doesn't affect how the policy grows. It doesn't deplete it, and you completely maintain your policy benefits while you're accessing those funds. Similar to a HELOC. Some people compare it to that. It's not exactly like that, but really, really close. And the other thing is, you have that ability now. You have this line of credit, if you will, and you can utilize that as a financing tool to invest in other opportunities or cover major expenses such as a car or a second vacation home or whatever it is that you're looking for.
So Jason, I always hear but I have to pay a little bit of interest. So speak to, there is a small cost to typically borrow, right, against your own policy. Why is that still so advantageous against other kinds of lending?
Great question, Loral. The first thing we have to realize is there's a cost.
That's one of ours as partners. Like, that's one of our biggest excuses is, well, I have to pay interest. It's like, well, yeah, but it's still better. So explain that. Why better?
Yeah. Well, most of the people like that don't understand interest. You're either passing up interest or gaining interest. When you pay cash, you're passing it up. So by default, you're paying interest, right? The really cool thing is that when you take a loan against your policy continues to accrue interest and dividends at its gross, not the net between what the cash value is in the loan. So it still continues to compound uninterrupted. And over time, that is one of the major forces on the planet for building wealth.
It is. And so speak more to those benefits of borrowing against your policy, because I think a lot of people see it as, I've heard this too, it's my emergency fund just in case I'll go get it, versus when we met, you were probably one of the most aggressive that I've ever seen, use it for real estate, use it to buy apartments. You use it as a funding source, not like an emergency, just in case I'll go get it.
Absolutely. I use it for all of those things. I've used it to finance cars for my children that, right when they get out of high school. We haven't had make your kids Millionaires book for that long. And so they don't have good credit or anything, and they need help with that. We've financed cars for that, done all kinds of things, done equipment financing for businesses. We have financed inventory for businesses and even purchased businesses using those cash values. Again, the real important thing here is you're acting like the banker. And many people think about that. So, well, I can use my 401k. Well, that's not really the same for the fact that it's really a withdrawal. And the 401k is growing on what's the net or what's left behind. Let's just, example is $100,000. You can take a $50,000 loan against your 401k. Well, really, your 401k has a balance of $50,000, what's left. And that's all the money that's growing there. When you do it with a life insurance policy, particularly from a mutual company, and you have $100,000 cash value, and you take a $50,000 loan, your money is compounding on the 100,000, not the 50 that's left. Most people don't understand that, and that difference between the two, it's huge over time.
Huge. It's huge, just compounding. So before we go to the last topic, I want you to speak on for this video, because we're going to do a whole series. Anybody that is out there, if you've not subscribed to my channel, subscribe, click that notification button. I need you here 5 days a week. It's family friendly, and start getting your kids into these topics, even if it's boring life insurance. Well, I don't want to listen to it. Kids need to hear all facets of their life, and it's all here on the channel. So make sure that you are here with your family. Jason brought 6 kids to the big table and into the community, and super excited about that. So again, all of you do that. I say, Jason and I, we both have a gift for you that's up on our website. You're going to grab that link in the description below. And Jason, back to you. Let's talk about the mistakes that are made when people, use their insurance to build wealth. What are the mistakes that you see there off the top?
Yeah, the very first mistake people make is they get the wrong vehicle. Now, we've had discussions before the difference between death insurance and life insurance. True life insurance really has 3 aspects to it. Number 1, there is a death benefit, and that's very important. Number 2, it's a deferred asset. In other words, it can be used in passive income time. Other people will call that retirement. We don't ever use that dirty word. And number 3, it's a current asset, right? Your life insurance don't have those 3 aspects, then it's the wrong kind. That's the biggest mistake people make, is they're choosing the wrong kind of policy, and it's not designed for the individual. In other words, the policy owners, for them to get cash versus commission for the agent. There's a lot of wiggle room there for agents. Another problem that they have is they don't commit to a long term with these things. I mean, who on the planet would purchase a house, maybe put a down payment, and then live there for a couple of years, make mortgage payments, and then walk away? No one does that, right? For the fact they know they have that equity, and they know that it is continuing to grow and becoming something very good for them. So not being committed to this, you can have a financial loss when you're, give up too early. And also another problem that people have is they think, oh, it's my money. I borrowed it. I'm not going to pay it back. You need to make provisions to start paying back those loans against your policy. It restores the cash value for you, so you could use it for something else. It also restores the death benefit. Well, wait a minute, Jason. You said earlier that it doesn't affect the policy. Well, here's the thing. You are in total control of what's going on. And when you have a loan, let's say you have a big loan and then something tragic happens and you pass away, well, what happens to the loan? It is simply deducted from the death benefit. So when you have a really huge loan outstanding, it's beneficiary to restore that death benefit for the fact that it comes into existence income tax free to your beneficiaries.
Love that. We have a lot more to talk about, and we could go on in this conversation for a very long time, because the mistakes that I see people make, and I just want to reiterate and put some real numbers. So say somebody commits to $4,000 a month or $5,000 a month or $15,000 a month to contribute. What Jason's talking about is you don't just pay 2 mortgage payments. You don't just pay 2 life insurance payments. You want a monthly contribution in addition to also paying back the loan. So it's a huge asset that you're actually actively involved in. So we have more to talk about in the life insurance department. So stay tuned. We are going to do a whole series as we speak. If you have any questions, go to askloral.com, ASKLORAL. Ask a question, make a request. We'll be back tomorrow.